Hello, everybody. Welcome to Power Trading Radio for our weekend edition. As always, I'm joined by the ambassador of opportunity, Mr. John O'Donnell. John, how you doing?
I'm great. How are you?
Pretty good. It's been actually a pretty exciting week in the financial markets. We've had a lot of nice trades going on natural gas, on the Japanese yen, so a lot of good stuff going on out there. I know we have some very special guests coming up in just a second, so for our weekend edition, let us just real quickly run through some of the numbers. TJ, my chart master, if you would, let's bring up the S&P 500 here just so we can take a quick peek at what is going on for the week. Pretty darn good out there, if you ask me. I'm trying to get rid of this yellow circle for everybody there. But the S&P on the day was up, even though it was mostly from a gap. Actually, if you look at the candle there, we had a nice little red candle, so it closed down from the open, but from yesterday's close was up a quarter of a percentage point. NASDAQ was up 0.61%, and the Dow was up 0.18%. But what I want to do is just real quickly show you from Monday's open, where we open on Monday to where we closed today, we had about a 2.89% of the SPY. So all in all, a pretty good week. For those of you who are perma bulls or getting super excited and thinking about buying, be careful. We're about to run into the ceiling that we saw a couple weeks back, right around that 142 mark. At that level, I might be looking to unload a little bit of my position here.
That's some serious supply up there.
It is, and we've had a pretty ballistic run going into it. So as we progress through next week, some of the economic announcements and maybe some of the earnings could push us up to those levels. But I would certainly be wary about buying in at these levels right now. So let's shift things over, John. I know John always is out there looking for interesting guests to bring on the program and maybe show us some things that we might not normally be privy to. Look at some different perspectives of the financial market. So, John, what do we got today? What's our guest for the week?
Well, we're going to look at alternative investments. We're going to look at the insurance industry, which is now being educated to the American public in a totally different manner. And I brought in a couple of experts to compare becoming your own personal banker and comparing the insurance industry to the banking industry and see what we can do to. Now, why is this important to me right now? As you know, Merlin, I had a death in my family. My brother passed away unexpectedly at age 62. And I had to go back to the funeral, and I really, on the way home, really started thinking about estate planning and settlement of estate and financing, and then what happens to the assets of, there is a concept out there called buy term, insure a risk, and invest the difference, because you can buy a lot more death benefit, if there is such a thing as a death benefit, for less dollars. And there's another concept out there called whole life insurance, where you get less coverage. But there's some other unique banking relationships. And these two guys with Generational Wealth Partners, I got in touch with and invited them on the show, and we're going to look at insurance today. We've never talked about this. And doing my study, I'm convinced there's a place in your big bucket for insurance.
Sure, especially for those with families and dependents.
That's correct. And as an alternative to banking assets, and they're going to help us way through this. So we're going to bring up Rich Keel and Brian Bailey. They're with Generational Wealth Partners, and their website is genwealth.net. So, guys, are you with us today?
We are.
How are you?
How are you? Great. Sunny Friday in Seattle, so it's a great day.
That's a kind of a conundrum as well. Sunny in Seattle. I love it up there. We have an office actually out there in Seattle, and just a great place to be. So, congratulations on a sunny day.
Let's, fellas, give us the cursory overview of the concept, and we've got some PowerPoint visuals that we can bring up, Merlin. Perhaps they can, the first one we're going to bring up on screen, does the bank control your money more than you? And fellas, we're going to turn this over to you. We'll interrupt with a few questions along the way, but let's get into this conversation, okay?
Yeah, I'd love to. Well, first of all, a little bit about myself. I'm 25 years in financial services.
This is Rich, right?
Oh, forgive me. Yeah, this is Rich Keel.
All right, Kitch.
And
your partner Brian's on the line as well, correct?
Yeah, Brian Bewley.
All right.
He's actually, I'm here in Seattle, and he's in Michigan. And we've been working together for about 5 years. He's my younger partner, and probably one of the sharpest young men I've ever met in finance. And
wonderful.
We've been taking a very alternative look at insurance and financial services for many years. I was born again financially about 10 years ago when I met a man by the name of Nelson Nash, who wrote a book called Becoming Your Own Banker. And he's the one that helped me kind of have a shift relative to how you look at the insurance company and life insurance as really kind of your liquid bond portfolio with a death benefit. And so we started tearing that apart and looking at how that fit as an asset class into somebody's life, into their overall financial model. And so over the last 10 years, we've really been working on perfecting this concept, and now we wholesale this concept to many other financial advisors throughout the country.
Very good.
And
what has been the reception when you go out to the traditional life insurance agent community that looks at insurance from a totally different perspective? Do you get pushback on the concept? Are they starting to embrace it? Because in a moment here, you're going to describe the concept for us and our audience. But do you get a lot of pushback from the traditional life insurance agent on the street?
Well, the typical agent we do, because the agents are selling death benefit for a commission.
Okay.
And so we figured out ultimately that we had to go to the advisory community and educate them on an asset class they just really knew little about.
You mean the investment advisory community?
Correct.
Okay.
Correct. The registered investment, more of the independent guys. It's almost life insurance is almost a dirty word if you're at one of the brokerage houses with a broker dealer.
Mm-hmm.
And if they do come up with a life insurance solution, they generally always push people towards variable life insurance, where the life insurance is tied to mutual funds inside the life insurance wrapper, and we're vehemently opposed to, simply being long and naked in the market is what I always call it.
Now let's get into this too. You also have a very specific point of view that you're against buy term and invest the difference concept. Is that correct?
Well,
or is there a space on a case-by-case basis in your practice? Is there a case to buy term to hedge a particular risk?
The only time I'm going to buy or I'm going to get involved in a term conversation is one case I'm working on right now with a physician who's my brother-in-law, where they only need to cover life insurance for a note for 5 years.
I see. Okay.
But I can prove to him in every way that 6 years on, if he does it my way, he can own the death benefit for the same, a lower net cost, and basically have this bank account with a death benefit.
I see.
And so what we're showing people is how to reposition other liquid assets that might be in money markets or bond funds, CDs, cash or liquid instruments. It needs to sit over here and gain the benefit of asset protection, tax benefits, and sometimes I refer to this as an unlimited muni bond portfolio with a death benefit, or an unlimited liquid municipal bond portfolio with a death benefit.
Well, that's an interesting position.
Yeah, one of my best clients out here in Seattle was one of the largest bond traders west of the Mississippi, and he just said, I don't really want to buy any cash value life insurance. And when I spun it that way, and I said, how about this liquid muni bond portfolio? It caused him to pause and rethink. Well, wait a minute, who's been the buyer of these bonds that I've been selling all these years?
Insurance company.
In the insurance company.
Yeah, absolutely.
That's right.
Well, tell you what, let's do this. I want to. We're going to cut to a commercial break here real quick. When we come back, for our listeners out there, that it might be a little bit different from the normal program. We've got Brian Booley with us and Richard Keel from Generation Wealth Partners. You know, we always talk about in this program how most people are taught to trade and invest the absolute wrong way. You've been taught historically to do it the wrong way. I think the same thing is going on with life insurance. When we come back, we'll talk to these two about what are some of the big misconceptions, how we can clarify a lot of those pieces, and really maybe take control of that investment as well. We've been talking about these different asset buckets, John, our A bucket, B bucket, C bucket for house. You think life insurance is our D bucket?
Well, I think we're going to discover once we talk with Richard that these life insurance contracts they use will fit in our B bucket very nicely.
Absolutely. We'll tell you what, as a special treat, since John is back back with us in the studio with a very, very sharp shirt, I might add.
Thank
We're
you,
going to give
Myrna.
away some of his Why Gold, Why Now CDs. If you'd like a copy of that, give us a call right now at the studio. I'm giving away 3 per break. The number to dial is 888-304-8723. That's 888-304-8723 if you want a Why Gold, Why Now CD. And if you have questions regarding insurance, Power Blast us at PowerTradingRadio.com. We'll be right back. Are you ready to take your trading to the next level? Serious traders know that success depends not only on a thorough understanding of today's financial markets, but also on access to professional-grade trading tools. Whether you're an experienced trader or just starting out, TradeStation's award-winning combination of advanced technology and brokerage services offer a complete trading solution with all the tools you need to create, analyze, test, and execute your trading ideas and strategies. Did you ever wonder why some traders can identify and capitalize on trading opportunities in fast-moving markets while others can't? With uniquely powerful analytical tools like scanner and radar screeners, TradeStation allows you to scan, monitor, and rank thousands of symbols in real time based on virtually any criteria that you choose. No matter which markets you trade, stocks, options, forex, futures, if you're serious about trading, it's time to trade up to TradeStation. To get started today, go to TradeStation.com or call TradeStation representative at 800-808-9336. That's 800-808-9336.
Welcome back to Power Trading Radio Live and your host, Merlin Rothfeld, with today's special guest.
Hello, everybody. Welcome back to Power Trading Radio. We are doing a little bit different show today. Normally, we are, strictly investment orientated, and John went out and did a bunch of research, and he's been arguing the point with me. Not really arguing; he's just making me realize that I don't know what I don't know. That insurance plays a major part as an investment vehicle. So he's gone out to Generational Wealth Partners. We've got Richard Keel and Brian Booley on the line, and listen, guys, I'd like to kind of know 2 things here. First, let's help our listeners understand how does this fit in as an investment vehicle for our listeners, and then after, I really want to know what are some of the major misconceptions and faults of insurance. We there?
Are you there, Brian? You want to grab that one, Brian?
Someone will tackle it.
Well, somebody grab it.
Absolutely.
Is this
trading community.
Is this Brian?
This is Brian Bewley.
Okay,
right.
Brian.
With the trading community, I think where they're going to really identify with cash value life insurance and its utility is thinking of it as a cash account, an ultimate cash account, if you will.
Okay.
And something that you can back into and lever out of with very little complication. And so it's kind of like creating a default position in your life with needs that you already have established, whether that's the life insurance need, the asset protection need, and the need for capital. And so when there are opportunities to obtain a greater return than what can be had through the cash value component of the life insurance and the cost of capital when you do take a policy loan, you have that opportunity and should take that. And so that's really how we, in communicating that to somebody who's going to be an active investor, that you really need to see the utility and that access of the cash as as important as some of the other features that are normally looked at when evaluating life insurance.
Right. Okay, so I guess one of my misconceptions, and this is where John is kind of correcting me, is, I'm a younger guy. I've got no dependents, no kids, no wife, no nothing. I could really care less about it. I'm not so concerned about if I die that somebody gets money from it. But it's one of those things I feel like I keep putting money into year over year over year. I don't get any reward out of it. What you're saying is I could actually tap into that as an asset source if I need it. Take a loan out of it.
Absolutely.
Correct.
And
let me jump on.
Okay, go ahead.
So let me jump on this one. One of the things that we show people almost without fail every time, I sit down in a meeting and I say, what if I could show you a way to borrow at 6% and earn at a 4% rate and make money? And I do this with accountants all the time, and they go, well, you're losing too, or many people do. And then we show them the difference of, they're 2 different equations. I have 4% compounding constantly in that account, and I pay 6% interest against that. So there's a spread there where I'm in a positive territory. It's like a margin account all the time on an asset class that is tax-free, and you can pick up deductions if you use it for investment purposes and so on. And those are things that we have to demonstrate to somebody mathematically to show them Okay, here's the real win. You wouldn't, if you knew about CD secured loans at the bank when banks were paying, decent interest, you would do them all the time if you understood that concept.
Let's start to go through the PowerPoint you sent us, Brian. Can we do that? We've got them up on the screen now, so our viewers and listeners can go to PowerTradingRadio.com if you'd like to see them. But do you want to walk us through this PowerPoint and share with us the concept of your program versus a banking relationship?
I think that walking through that PowerPoint I'm going to have to pull it up on my end to see it because I don't have your website up currently.
Well, I can walk you through. Let's talk about your old paradigm. It says, does the bank control your money more than you? And you have this old paradigm, which has speculation massive and insurance minimal. And
well, we have an inverted pyramid
right.
with speculative investments at the top. Go ahead, Marlon.
Speculative investments at the top. Basically, we talk about that as being a way to enhance your standard of living. You've got kind of the middle portion of the triangle, which says long-term investments to solve for baseline retirement income. And then the bottom of this, which is really the smaller portion, says insurance and emergency fund to solve for finance and at least 6 months of working capital. And you say that's the old paradigm. Why is that?
That's the traditional model that you'll get from a typical estate planner. Okay, let's go to the next slide because this is the new paradigm. They take that pyramid and turn it on its head.
Right,
okay.
And so the bigger piece here, the largest piece, the base of that pyramid is insurance and emergency fund, saying I want to have enough to be basically carry me for 6 months.
Yes, plus the coverage of the death benefit.
Right.
But notice how what component of the pyramid went to the top, the size, and how the middle changed. The middle, quite frankly, didn't really change too much.
Is that right, guys?
That's correct. And so, what we're trying to impart conceptually here is that, in the traditional model, what have you done typically out there in the marketplace? Everybody piles into the 401k plans. They're typically restricted on many of the investments they have access to. And you can quantify that, or the risk is speculative, right? Mm-hmm. And so that's where we've traditionally put all of our money initially. And then if you listen to any traditional financial planners, they'll tell you that you need to max out all of those qualified plans first. So essentially go pile into the speculative investments mm-hmm. and give short shrift to a sound financial base, savings. And let's make some distinctions here between savings and investment so that we can weather the storms that inevitably happen in life.
It's a very interesting point. Most people don't distinguish between savings and investment.
Correct.
By the way, if one of you have speakers on, you ought to turn down your speakers. We're getting feedback. All right, let's go on to the next slide.
All right, cash flow. Let's talk about our cash flow coach. What do we got?
Okay. So, man, I wish I could pull up this presentation.
I wish you could, too. You want us to read it to you?
Yeah. Well, the cash flow coach, if I remember correctly on this slide.
Well, let's read it to you. Let us read it to you real quickly so we don't miss it. Go ahead.
All right. I'll read through it. I'll be a proxy narrator here. Using conventional methods of financial management, you are at the whim of banks and other financial institutions, and we all hate being at the whim of other financial institutions, that's for sure. You are charged interest, incur excess fees, and are subject to a constant review by various crediting bureaus. By properly capitalizing into a dividend-paying whole life product, we can create a financial foundation that potentially satisfies most, if not all, of your needs for financial working capital and a tax-favored environment.
Very good. You want to opine on that, guys?
Oh, I think it captured it all. Rich, I'm going to let you jump in on that.
No, I was just trying to pull this piece up.
Okay, let's go on to the next
one. I'll do us a quick favor. Hold on, guys. We got to cut for a commercial break here, so let's do this. I'll let you guys get that PowerPoint up and running, so at least we're all on the same page here. If you guys have questions regarding insurance and related products, what I want to dive into next is what are most people doing wrong? That's one of the big things for me as an equities trader. Most people have no clue how the financial markets really work. You realize that with a finance degree, that the financial world is teaching you to do things the wrong way. we'll establish that differentiator here with the insurance products. Then we'll start working on, what are some of the things that we can do to build a better portfolio and add some insurance products into it as well. So when we come back, we'll get into that. If you have questions for us, Power Blast us out at PowerTradingRadio.com. If you would like one of John's Why Gold, Why Now CDs, now's the time. 3 of them going away to the first 3 callers at 888-304-8723. That's 888-304-8723. We'll be right back.
Slide 4, right? Okay, we're back. My name is John O'Donnell. Merlin's here today, and we've got Rich and Brian with us from Generational Wealth Partners at genwealth.net. Guys, did you get your PowerPoint? Did you find your PowerPoint?
Oh, there we go.
Hello?
There we go.
Hello, Rich and Brian?
We're here now.
How are you?
Oh, perfect.
Were you able to find your PowerPoint?
Yeah, we just thought it was going to be displayed on that blackboard.
No. We need to have it in front of you. Okay, we need to pull up slide number 4, which is Cash Flow Essential, the fundamentals of banking, and how you compare insurance to banking. You want to take that through us quickly. This is kind of a short segment, so you need to be a little, step up the delivery a little bit on this particular section.
Yeah, will do. Banking is a process, not a product.
Okay.
And I think that most people are always thinking financial products, or at least that's what we believe that is being peddled out there for the most part. And when you think of banking, you really have to think about collateralization and how money is actively used.
Mm-hmm.
And so what we've done that's unique in the marketplace is we've shown people how to actively manage or kind of like self-direct their life insurance.
Okay.
In fact, I've created or coined the term hybrid life, where we basically show somebody how to, or that it's not either or, it's this and. In other words, I can be in the life insurance and I can be in gold or any other asset class.
Okay.
We have many clients that are in the real estate sector doing flipping homes and you just name it. It's anything goes.
And that's different than the paradigm where we have this, I put my money in there and I just leave it. And the same thing's happening with IRAs and 401ks now. We do a lot of education in that area where it's like, look, let's self-direct it. There's a lot more power and bang for your buck and things that you can do to get better rates of return.
Right. We're self-directing a non-qualified instrument, if I could put it that way.
Right.
But, Rich, let me jump in on this one here, because one of the things that's so easy to overlook in this whole process and with the life insurance or any other asset class, it's that you're collateralizing. So the money's staying in the contract. You're not borrowing the money out. You're not taking the money out. You're borrowing against it. And so the earnings or the growth within that contract still exists. And then you also have the earnings from, whatever it is that you're investing in. Now, you do incur a cost of capital, right? The cost of money that is charged from the insurance company. But when you look at the numbers and you break this down, by not giving up earnings. And, Rich, how did I used to put this? I used to say access to capital without sacrificing rate of return.
Nice.
And it's all about not liquidating the underlying investment, the underlying savings. I should not mince words here. The underlying savings that you're using to support those investments.
All right. Fellas, the rules of the road that you've laid down is, number 1, pay yourself first. Control of capital is key. Convert liabilities into assets. You want to be a creditor, not a debtor. Transfer risk away at all times. Boy, Merlin, we can embrace that one,
Absolutely.
can't we? And reduce exposure of assets to creditors and lawsuits, and that's where asset protection would come in. And a lot of people don't talk about the benefits of life insurance by ring fencing exposure to your assets from creditors and predators that may lurk around there. We don't get any of that safeguard in a bank account, do we?
Not at all. Not whatsoever. I have one of my or two of my clients have exercised that right in the last few years because their real estate loans kind of got away from them, or, well, the market did, whatever.
One or the other.
Yeah.
All right, let's we're going to take a quick break. If you want a copy of John's Why Gold, Why Now CD, now is the time to give us a call at 888-304-8723. That's 888-304-8723. For those that are just joining us, we're taking a different slant. We're looking at insurance products, which many of you are like, I don't need insurance. Well, actually, you do. And I think in looking at things in a non-traditional approach, certainly something All Main Trading Academy prides itself at is looking at ways to invest in the market from a different perspective. Generational Wealth Partners with Richard Keel and Brian Booley. presenting to us maybe some different ways of doing it. Did you think that you could self-direct your life insurance? You can. So we've been talking about that. We'll get more into that when we come back after a quick break. If you have questions for any of us in the program, Brian or Richard, John or myself, Power Blast us out at PowerTradingRadio.com. And again, I'm giving out 3 Why Gold, Why Now CDs of John O'Donnell if you like. 888-304-8723. We'll be right back.
Power Trading Radio Live is back with a look at what lies ahead for the next trading day and today's Power Picks. Here again is Merlin Rothfeld.
Hello, everybody. Welcome back to Power Trading Radio. Merlin Rothfeld with John O'Donnell. And as I've been talking about, we're doing things slightly differently. We've got Brian Booley on the line and Richard Keel of Generational Wealth Partners talking about a product that's a little bit different for those that can view out at home. We do have some slides up here which kind of walk through some of the big talking points. And John, just before we broke, you were going into a deep thought here, I think, on cash flow, which is kind of talking about the automating of a lot of these processes. So I'll let you get back to that and get back to Richard and Brian.
Well, the process that these guys are recommending is to automate everything. And if we can go to the sample, Merlin, where you show cash flow management, guys, I don't know what slide number that is. What is that, slide number 8?
7.
Slide number 7. Kind of walk us through. This is a schematic of how you organize as an alternative the use of whole life insurance versus a banking relationship. And I thought this was very interesting and very creative.
Well, I'll go ahead and take that one. And so when you look at this model of cash flow management, what you see on the left side is income coming into a checking or savings account, a put and take account, and then expenses coming out of it.
At the bottom on the left, okay?
On the bottom left. And that's your typical model. That's what 90% of people do.
Very good.
And so what we can do is we can introduce a couple of other accounts, like a line of credit, and there's very specific lines of credit. You can use home equity lines or unsecured lines. And you learn how to use that and a life insurance contract to, and I'm going to paint a vision here. The idea here is to create a situation where you have zero balance checking and surplus capital, like your surplus or deficit of your budget, flowing into your assets every month. So that way you're accumulating assets in a place that you own and control, that's asset protected, and you're only leaving the liability there with the bank until you ultimately take some money back out and cover that line of credit.
So you're accumulating assets in your cash value of your life insurance contract. Correct. Is that correct?
Yes.
In lieu of putting it in a bank account and a savings account as an example.
Correct.
Okay, go ahead.
And then there'll, some of your listeners might think, well, geez, how much cash value can I possibly fit into this account? And at the end of the day, part of what we're talking about here is levering this account, right? Getting money out and actively using it in your other investments. And so what ends up happening is you've actually created an interest offset account. So if I have cash value in a life insurance contract that I'm actively investing,
right,
and then every month I'm reducing that balance against it, I've created a very effective interest offset strategy while solving for my death benefits, while knocking out all of these, items on my punch list that need to be accomplished.
Well, how am I going to cover all my living expenses?
Oh, your living expenses get covered by, in this situation, it would be like a line of credit, right? You cover your living expenses there. So what you're doing is you're paying that line of credit back off again.
All right. So on the right, you're showing I'm going to pay my expenses on a day-by-day basis with a credit card, perhaps issued by the same bank, okay?
Sure.
And now let's talk about I'm going to have to one day pay off that credit card. I just can't leave that open indefinitely. So, Merlin, let's go to the next slide because I think we have a schematic of how this will cash flow in month 1, 2, and 3. You want to walk this through us, and we'll kind of move the $8,000 along as it transfers.
Absolutely. So when you click down, you'll see that $8,000 flows into our bank account, right? And that's our monthly income, and we satisfy some minimum payments and whatnot when you click it next. And then,
all right, in this example, I've got $2,000 of minimum payments I take care of. Perhaps that's a mortgage or whatever. And I've got $6,000 left over, and where does that go?
That goes back to the permanent life insurance contract.
Okay.
On the bottom of the screen.
So that's part of the. Go ahead.
No, and so that's that's just part of the cash value of your life insurance contract. And then when you click next, you'll see on the right there a line of credit, $5,000 of expenses going on that line of credit.
Very good.
Okay. Now, we'll go through and you'll see it goes to month 2, and it'll do the exact same process again. 8,000 of income in, it gets split between minimum payments and the life insurance contract.
Very good.
And our expenses are building up on that line of credit. And you might ask yourself, well, how is that line of credit getting paid? And it's being that minimum payment, okay? And so by the end of the 3rd month, if you just go ahead and advance through that, you'll notice that you've accumulated $6,000 a month or $18,000 of that life insurance contract and $5,000 per month of expenses on the line of credit.
Okay. Yep.
So we'll take the policy loan there, and we will cover that balance on the line of credit, and the surplus that existed in our budget over that period of time will remain in the life insurance contract, much the same way it would have remained in there in our bank account. However, it's over here now,
right,
in our own.
Yeah, it's funny. John explained this to me in a real layman way on the last break, because I guess I'm an idiot when it comes to this model here. And he says, essentially, instead of going and putting in $10,000, or let's say here you have $8,000 you're putting in your bank account, instead of just leaving that money in the bank account, by putting that money into a life insurance contract, I can now pull that money right back out. I can actually access that cash. I can use that for whatever I want. It got tax advantages, as well as it's got a little, I guess, a parachute that if I do die, I've got a life insurance contract strapped to the back.
And it's asset protected.
Right. Am I right in that?
Correct.
Yes. And one of the things to really remember here is that we're not defying the laws of finance. And one of the most important things to think about is that the cash flow management is meant to implement an interest offset strategy, while when you borrow money and you incur a cost of capital, we all know one thing, and that is that investment has to be productive, right?
Yep.
And so I don't want the listeners to think, well, geez, I'm financing my daily living expenses. That doesn't make any sense. Not really. You're utilizing the cash flow of your daily living to create an interest offset strategy, while using the life insurance contract to support investments. So, I think it's very important to key in on that, because we always want to be productive whenever we're incurring that cost of capital.
Therefore, you have accomplished with this model, you've created a consistent cash flow. You've enabled you to focus on a strategy instead of tactics. You've shifted bad debts to good debt. You've created a staging point for the foundational capital. You solved for private safety net, tax advantage emergency fund, and you practically and organized implementation of what you call infinite banking concept. What is, for the layman, the infinite banking concept in your model?
Well, it has to do with the concept that you finance everything you buy. And it's opportunity cost is financial gravity. And so we're helping people reconcile that reality in their lives. And I think it's something that most people never really consider. And I don't know if this is a good jump-off point for this, but I always ask people the question about their IRA or their qualified plan. Why do you think that your qualified plan is not you're not able to use that asset as collateral? And
that's a very good point.
It's a little food for thought here, because
it's a very good
banks
point, Rich.
And the institutions do not really want you to have collateral in your account to control the cost of money. And I emailed this morning an ERISA attorney to ask him where I could find some resources on why that was written into the legislation so many years ago. I mean, the ERISA is just part of our lives now, but the whole IRA concept and all of that, like we really needed the government to tell us to save money, but they created this methodology to put our money in jail. And so, our goal is to help people understand how to get it out of jail and how to actively use it, create these efficiencies. And we always say the best financial plan is maximum money supply and benefits simultaneously. And that's what we're trying to produce. We're efficiency experts in our model. And, if we can eke out an extra $5,000 a year in efficiency and put that at X rate of return, what was that recovery?
Right.
I mean, what did that create for you in your lifetime? So our life insurance, our clients all recognize that I hate to say this boldly on a radio show, but our life insurance contracts are all free, or the death benefit just comes with the territory, which answers your previous question about, term, buy term, and invest the difference.
Mm-hmm.
Well, if I can get you a free death benefit because of the efficiency of being an owner in a mutual company by driving a volume of money through that institution, why wouldn't you take the free heat?
Sure.
I thought a free death benefit was an oxymoron.
Yeah.
All right.
Well,
Thank you, Rich, and thank you, Brian. This is Generational Wealth Partners. They're at www.genwealth.net. I encourage you to go check these guys out and reconsider how you use life insurance in your estate. Thanks, guys. Good luck to you.
Thank you. Thank you very much.
Thank you for having us.
No problem, pleasure. All right, guys, if you want more information, it's genwealth.net. TJ's going to put that full screen as I kind of wrap up here for this segment. I want to make sure you guys all have the opportunity to get one of John's Why Gold, Why Now CDs. If you'd like a copy of that, give us a call here at the studio. Number is 888-304-8723. That's 888-304-8723. And we'll be right back after a quick break with a lot of economic news for Monday and really kind of get you up to speed of what should happen on Monday. We'll be right back after a short break. John, I hope you have a fantastic weekend. Oh. All right, everybody, welcome back to Power Trading Radio. Merlin Rothfeld wrapping up our weekend edition here. I want to thank John O'Donnell for coming on the program and bringing on those great guests. We had Brian Booley and Richard Keel of Generational Wealth Partners. And, again, the topic today was very different than what we normally talk about, but I think it has to do with, or more importantly, it has to do with self-directing, making sure that you do things yourself and really know what you're doing with your money. Pointed out as he walked out of the studio, he says, one of the best things about this is you don't have to put your money in one of these too big to fail banks like Bank of America or Wells Fargo. You're going straight to the insurance company, albeit they're not exactly straight shooters either, but they're a little bit safer and maybe not too big to fail. So if it's something you're interested in, you can get more information. I'll put some information on the blog here in a little bit. Let's look at our economic calendar for Monday, the 30th of April. You can see at 8:30 in the morning, PCE price index and personal income and spending for the U.S. markets at 9:45 Chicago PMI. That's it for U.S. If you're looking at the Canadian dollar, you have their GDP numbers coming out as well as German retail sales. Earnings front, got a little bit quieter. Not a lot going on. We've got Lowe's. New York Group is one of the major names out there, but really not a ton going on as far as earnings announcements for next week. There's a few coming up later in the week, but not right from the get-go. And let's go to our guest. Brandon Tristan, one of the top guys in XLT, Sam Seiden, the VP of Education for Online Trading Academy, Bill Henner, Tilly Allison, John O'Donnell. We've got a week chock full of good stuff. I'm going to bring on a lot of XLT examples so you guys can see what goes on in this online mentoring room, so make sure you tune in for that. If you have questions, you can always power blast us out at PowerTradingRadio.com so we can start to get those questions ready for the week. We would love to hear from it. Now, if you're thinking about getting involved in investing, whether it is that insurance policy or futures, options, currencies, whatever, make sure that you go to the right stop, and that's going to be Online Trading Academy. To find out more, call us 888-304-8723. I got cut, didn't I?